All right, CA friends, let's get straight into it. Today, we're going to break down one of the most fundamental standards out there, one that ICAI absolutely loves to test, AS-9, revenue recognition. And we're going to start with a situation that I'm sure gives a lot of you nightmares.
Picture this. You're in the exam hall. You see a question about a sale, you book the revenue, you feel great about it, you move on, confident you've got full marks. But then the results come out and a big fat 0 for that question. What on earth went wrong? Well, that's exactly what we're here to figure out, and I promise by the end of this, it will never happen to you.
So let's look at a classic exam problem. Company AB makes a sale to Company CD. Simple enough, right? But here's the catch. Everyone knows Company CD is struggling with cash. They might not be able to pay. So what do? Do you book the revenue right away? Do you wait? Do you do nothing? The entire answer, all the marks, are hidden inside AS-9.
So how do we even begin to tackle this? Well, like with any accounting standard, we've got to go back to basics. Before we can figure out when to book revenue, we need to be absolutely crystal clear on what the standard even considers to be revenue in the first place. Okay, so here it is, the official definition. It's a gross inflow, but here's the part I want you to burn into your memory. The most important 2 words on this slide, the ones ICAI loves to test you on, are ordinary activities. It's not just any money coming in. It has to be from your normal, day-to-day business operations.
Let's make this super clear. On one hand, you have a real estate developer. What's their ordinary activity? Selling land. So when they sell a plot for 240 crore, the whole amount is revenue. But on the other hand, what if a pharma company sells an old factory machine? Is that their main business? No way. So in that case, you don't book the full sale price as revenue. You only book the profit or loss on that sale. This is a classic trap where students lose marks. You have to ask yourself, is this their main gig?
Now, just as important as knowing what's in AS-9 is knowing what's out. This is a quick rundown of things that have their own separate accounting standards. So, construction contracts, leases, government grants, don't even think about applying AS-9 to these. They have their own set of rules.
Okay, let's talk about another place where marks just disappear. It's the whole principal versus agent thing. You absolutely have to know the difference. Are you the one actually providing the goods or services, or are you just arranging the sale for someone else? The answer dramatically changes how much revenue you book. Let's use a food delivery app like Zagato to really nail this down. Think about it. Who's responsible for the food? The restaurant, right? They bear the risks of the food quality. So the restaurant is the principal for the food, and they book the full 200 lakhs. What about Zagato? They're just the agent for the food, but they are the principal for the delivery. So they only recognize the 60 lakh delivery fee as their revenue. And hey, a quick pro tip. See that GST? Never, ever, ever book that as revenue. That's a liability to the government, a direct ticket to losing marks.
So, what's the ultimate test? It always, and I mean always, boils down to one question. Who bears the risk? Let's take a travel agent. If they buy 100 tickets from an airline up front and are stuck with any they can't sell, they bear the risk. They are the principal and book the full ticket price as revenue. But if they just book tickets on behalf of customers for a commission with no risk of loss, they're an agent. They only book the commission. If you remember one thing here, remember this. Risk is the deciding factor.
Okay, so we've got the basics down. We know what revenue is and how to figure out if we're a principal or an agent. Now let's get into the nitty-gritty, the 3 main ways AS-9 says you can earn revenue.
For the sale of goods, this is your holy trinity, your 3 commandments. You have to meet all 3 of these conditions. Not 1, not 2, but all 3. The risks and rewards have to be transferred. You can't have any lingering control over the goods. And look at that last one. There can be no significant uncertainty about getting paid. If even one of these boxes isn't ticked, you cannot book that revenue. End of story.
Now, what about services? It's a bit different. Think of it like this. Are you performing a long, ongoing service or a quick one-and-done job? If it's something long-term, like a 3-year annual maintenance contract, you use the proportionate completion method. You recognize the revenue bit by bit over the 3 years. But if it's a single act, like fixing a flat tire, you use the completed service method. You wait until the job is totally done, and then you book all the revenue at once. This is a favorite theory question, so make sure you know the difference.
And finally, we have other incomes. Interest? Simple. You recognize it based on time.
Royalties, you just follow what the agreement says on an accrual basis. But dividends, ding, 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 this is a huge ICAI trap. You book the revenue when the dividend is declared, not when it's just proposed. The moment you have the legal right to receive it, that's when it hits your books. Get this wrong, and you're just giving away precious marks.
All right, buckle up. This next section is what separates the top scorers from everyone else. We're heading into the exam battleground, the tricky, specific scenarios that ICAI loves to throw at you in practical problems. Let's do this.
First up, the buyer asks you to delay delivery. Can you book the revenue? Yes, but only if the goods are ready to go, they belong to that specific buyer, and, crucially, the buyer asked for the delay. Next, sale and approval. This one's easy. No revenue until the customer either says, yes, I'll take it, or their time to say no runs out. And what about installation? It all depends. If it's a huge, complex job that's a key part of the sale, you wait until the installation is done. If it's just plugging it in, you can book the revenue on delivery.
Okay, everyone, lean in for this one. This is one of the biggest, most deceptive traps in AS-9. Sale and repurchase. It looks like a sale, it smells like a sale, but it is not a sale. It's a loan in disguise. You're getting cash now and promising to buy back the goods later for more money. That extra money is just interest. So you record a loan, you record interest expense, and then you repay the loan. Notice what's missing here? The word revenue. It never even touches your revenue account.
Let's talk discounts. Another easy place to slip up. Think of it this way. Trade discounts are given right at the start, reducing the invoice price itself, so you just book the net amount as revenue. Simple. Cash discounts, on the other hand, are a thank you for paying early. It's a financing expense, not a reduction of the sale value. So you book the gross revenue, and if the customer pays early, you book the discount as a separate expense. Don't mix them up. And our last special case, consignment sales. Look, just because your goods are sitting in someone else's shop doesn't mean you've sold them. You still own them, right? You're still bearing all the risk if they don't sell. So the rule is simple. You only book the revenue when that consignee sells the goods to the final customer, the third party. That's when the real sale happens. Okay, let's circle all the way back to that nightmare scenario we started with. The sale's made, but you're not sure you're ever going to see the cash. What now? This is absolutely critical, and this is where the big marks are.
And here's the million-dollar question. When did you find out about the uncertainty? The timing changes everything. If you knew from day one, at the time of sale, that collection was iffy, you cannot recognize revenue. You postpone it. But what if everything looked fine at the time of sale, and then a few weeks later, you hear the customer is in trouble? Well, you already booked the revenue. In that case, you can't go back and reverse it. Your only option is to create a provision for doubtful debt. This distinction, uncertainty at the time of sale versus uncertainty after the sale, is a classic ICAI twist.
And if you ever forget, just remember what the standard itself says. When the ability to assess the ultimate collection with reasonable certainty is lacking, revenue recognition is postponed. It's as simple as that. No certainty, no revenue. All right, we're on the home stretch. We've figured out what to do. But there's one last step, and it's an easy one to forget in an exam. You've got to talk about it in your disclosures. So you already know from AS-1 that you have to state your revenue recognition policies. But AS-9 makes you go one step further. If you've hit the brakes and postponed recognizing revenue because of uncertainty, you have to spell out exactly why in your notes to accounts. You need to tell the reader, hey, we made this claim with the railways, but since we're not sure we'll get the money, we haven't booked it as revenue yet. It's all about transparency. So, to wrap this all up, I'm going to leave you with a classic exam-style question. This one mixes a couple of the tricky scenarios we've talked about. So take a look, think about the rules for delayed delivery, think about the rules for consignment. What's the final revenue figure you'd book by March 31st? If you can nail this, you are in fantastic shape for IS-9. Go back, review, and make sure you've got this down cold.